Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is the What to Expect in Securitization 2024. My name is Tamim Zenelbai, and I'm a partner in Mayor Brown's banking and finance practice in our Chicago office. Joining me today are Mayor Brown partners Jim Antonopoulos, Joanna Nicholas, Evan DeCrease, and Melissa Kilcoyne. Jim, Joanna, and Melissa are partners in our banking and finance practice in our Chicago office, and Evan is a partner in our banking and finance practice in our New York office. With that said, let's begin. I'm going to talk briefly about residential mortgages and related assets, namely home equity investments, single-family rental, digital mortgage assets, mortgage servicing rights, and reverse mortgages. While 2023 saw depressed activity due to high interest rates and an inflationary environment, 2024 has already showed signs of picking up steam. Non-QM issuance, which was spotty but strong in 2023, is vibrant at the beginning of 24, and we expect that to continue throughout the year. At the end of 2023, the first rated home equity option contract securitization was completed. Home equity products remain in demand as a way for homeowners to tap into home equity without taking on a mortgage or a second mortgage. And mortgage servicing rights have increased in value due to rising interest rates. So, what are home equity investments? They are a product that allows a homeowner the ability to grant to a third party an interest in the homeowner's property in exchange for an upfront payment. It can be structured as an option or as a forward sale of an ownership interest in the property. The contract holder's rights under the home equity option contract are typically secured by a mortgage or a deed of trust. As mentioned earlier, there is incredible growth potential with this product because rising home prices mean homeowners have an unprecedented amount of untapped equity. Rising interest rates make debt options less attractive and discourage homeowners from selling. And recent rated securitizations provide a reliable takeout option for originators and contract owners. So in 2024, we expect to see higher warehousing and acquisition activity, as well as more and more securitizations now that there is a rated option. Moving on to SFRs. SFR as an asset class is proving durable, even when facing headwinds from high interest rates that compress DSCR and force down advance rates. Issuers are opportunistically selling homes in order to capture home price appreciation gains and relieve this DSCR pressure. And iBuying remains viable even in light of the challenges that force Zillow out of the market. iBuyers are active in the space and have continued to source and sell homes, identifying pockets of opportunity in a disjointed market. And as we have seen thus far in 2024, SFR financing and securitizations appear to be back on track, with even more encouraging signs after the announcement of Blackstone's acquisition of Tricon. With respect to digital assets, we think this is a booming area. Even in advance of the widespread adoption of the new UCC Article 12, which allows for security interests in controllable electronic records, we find that there has been widespread applicability and adoption. In particular, an e-note, which is an electronically signed promissory note, or an e-HELOC, which is an electronically signed line of credit agreement, are becoming more and more popular. And of course, the mortgage or deed of trust is typically also electronically signed and remote notarized. We find that this technology applies to both traditional mortgage loans and home equity lines of credit and closed-end seconds, and that there's a very broad vendor base at all stages of the production flow and strong consumer familiarity. As a result, there's ample opportunity for investment in these assets, and there continues to be innovation in the market, including blockchain applications. Over a dozen eVault providers are now in the market, and 6 document custodians are active in the MERS e-registry as an example. What we have found out is that as of January 1st, 2024, over 2 million notes were in the MERS e-registry. And as this technology scales, we see that as a key driver for adoption of digital mortgage assets. And we see that there will be continued focus and interest in this by all players in the market going into 2024. With respect to reverse mortgage loans, it was business as usual in 2023, other than Ginnie Mae making enhancements to its HECM program, streamlining the process for submitting assignable buyouts, allowing tails to be pulled multiple times a month, and we understand that they are in the process of launching some other improvements under the moniker HMBS 2.0, which would allow pooling of HECMs whose balance is more than 98% of the maximum claim amount. What we expect is continued activity in the reverse space, especially for new players trying to gain market share. For mortgage servicing rights, as mortgage rates rise, valuations of mortgage servicing rights tend to rise alongside them. We see continued interest in bilateral and multiple lender facilities to finance MSR portfolios, particularly with smaller to mid-sized servicers. In addition, there has been increased interest in setting up MSR funds, where investors invest in a licensed entity which purchases MSRs. Another structure that has become more popular is the sale by servicers of excess servicing spread, which opens up sources of financing to a broader pool of investors and not having the risk of marking the MSRs to market. However, servicers were also busy in 2023 and into 2024, focusing on compliance with Ginnie Mae's new risk-based capital ratio requirements, which in particular can make it difficult for servicers to sell excess servicing spread to the extent they are reflecting them as a liability on their balance sheet. We understand that there may be some releases from Ginnie Mae in the coming months to address this concern. And that's it for the mortgage market. Now passing it off to Joanna to discuss CLOs.
Thanks, Tamim. I'm Joanna Nicholas, and I'll be talking about collateralized loan obligations, or CLOs. Beginning with the Corporate Transparency Act, which is frequently referred to as the CTA. The CTA became effective January 1 of this year and requires certain entities to file reports with the U.S. Financial Enforcement Network called FinCEN. Later in this program, you'll hear more about the CTA from one of my colleagues, but I will cover its application to CLOs generally now. So how does this new rule apply to CLOs? First, with respect to CLO issuers. An offshore CLO issuer will generally not be a domestic reporting company for purposes of the CTA because it's formed outside of the U.S. and it does not register to do business in the U.S. Further, onshore 3C7 CLO issuers with registered investment advisors will generally be exempt from the CTA. There's an exemption for a pooled investment vehicle that is operated or advised by certain exempt entities, such as an investment company or investment advisor. That exemption is available for U.S. CLO issuers that rely on or could rely on the 3C7 exception to the Investment Company Act and which are identified in the Registered Investment Advisors Form ADV or will be so identified in the next annual updating amendment. So most CLO issuers are expected to be exempt from the CTA. But CLO issuers that rely only on 3A7 or are not managed by a registered investment advisor will not be pooled investment vehicles, and if they are onshore vehicles, they will need to find another solution to qualify as exempt for reporting. Turning now to CLO co-issuers. CLO co-issuers are generally formed under Delaware law and are expected to be domestic reporting entities under the CTA. As a result, a co-issuer will generally need to file applicant information from individuals who filed an application with a governmental authority to create or register that entity to do business, and beneficial ownership information from the beneficial owners of the co-issuer. So who are the beneficial owners of a CLO co-issuer for this purpose? Under the CTA, a beneficial owner is defined to include a person that directly or indirectly owns or controls at least 25% of the entity or has substantial control of the entity. So the independent manager or director of the issuer would be expected to be a beneficial owner by virtue of having substantial control of the co-issuer. And the CLO issuer would be a beneficial owner by virtue of directly owning the co-issuer. Treasury has indicated that a reporting company's beneficial owners may include the beneficial owners of a company that owns the reporting company. So this raises the specter that a CLO co-issuer could need to look through to the beneficial owners of the CLO issuer, which might be very difficult to do given that CLO securities are usually held in DTC. Regarding whether there is a need to look through a CLO issuer listed on a co-issuer's report to FinCEN, there is a special reporting rule with respect to reporting companies in which an ownership interest is held by certain exempt entities, such as a pooled investment vehicle. This rule says that the report may include the name of the exempt entity in lieu of looking through the exempt entity to its beneficial owners. So a CLO co-issuer whose ownership interest is owned by a CLO issuer that is exempt as a pooled investment vehicle can report just the CLO issuer's name as a beneficial owner. Turning now to certain SEC rules. There were a couple of SEC rules finalized last year that thankfully had more limited impact on CLOs than might have been the case. You will hear more about the conflicts of interest rule from my colleague later in the program, but importantly for CLOs, the definition of conflicted transaction and securitization participant were narrowed in the final rule, which limits the rule's impact on CLOs. However, CLO managers and CLO arrangers will need a Rule 192 compliance program and will need to put controls in place to prevent coordination by affiliates with the CLO arranger or manager, and to restrict access to information by affiliates and subsidiaries that are not involved in the CLO. And now turning to the final private funds rule, which imposes additional obligations on and restricts certain practices by advisors to private funds. CLOs are generally exempt from this rule. The SEC had proposed to prohibit an advisor to a private fund, which would include a CLO manager, from seeking reimbursement, indemnification, exculpation, or limitation of its liability for a breach of fiduciary duty, willful misfeasance, bad faith, negligence, or recklessness in providing services to the fund. The SEC stated that it did not adopt this prohibition, in part because it believes doing so is not necessary to achieve its goal of addressing this problematic practice. Instead, the SEC claimed it is reaffirming and clarifying its views on how an advisor's fiduciary duty applies to its private fund clients. The SEC indicated that it would violate the anti-fraud provisions of the Advisors Act for a management contract to have a provision that explicitly or generically waives the advisor's federal fiduciary duty if there is no language clarifying that the advisor is not waiving its federal fiduciary duty or that the client retains certain non-waivable rights. This is frequently called a savings clause. This sets up a clear regulatory expectation that advisory and similar contracts that in any way seek to limit an advisor's liability must include a savings clause. Many CLO management contracts already have this type of language, but CLO managers may wish to check their contracts and add this language if it isn't already present. And now turning to Melissa.
Hi, I'm Melissa Kilcoyne, and I'll be discussing expected trends and updates related to the auto and equipment securitization markets. Since mid-2021, we have seen losses and delinquencies across consumer asset classes, including autos, steadily increasing. To close out 2023, the market saw a leveling off of losses and delinquencies for prime auto loans, while more uncertainty remains in the subprime asset class. In the subprime category, the market is seeing the highest losses since 2019. Declining vehicle values also continue to plague the entire auto space, making recoveries lower than prior years and prior market and rating agency expectations. In the term ABS markets, January 2024 started off with a burst of issuances and tighter than expected spreads. We're seeing a lot of market participants ready to jump back into deal mode to take advantage of friendly market conditions, at least compared to most of 2023. The new issuance pipeline in the immediate future looks to continue to be promising, with many issuers ready to market and price deals ahead of another potential decline. Floating rate tranches have also been very popular over the last couple of years, which is expected to continue in the face of uncertain interest rate action by the Fed. In the auto space, these are almost universally tied to compounded SOFR at this time. After a very quiet couple of years for floor plan ABS transactions, we're expecting to see several new transactions with issuers stepping back into the space once again. Issuers are seeing a general easing of supply chain constraints, which has resulted in more cars sitting at dealerships across the country. This is in stark contrast to the recent period of bare dealer lots with limited floor plan financing being needed. Overall, we expect 2024 to be the year of the consumer, with strong securitization volume bolstered by falling interest rates. There is an expectation for a strong consumer demand for cars, but that will be tested with an uncertain global economy. Consumers in general are facing new student loan payments and rising costs all around. Not only are new vehicles themselves more expensive to purchase, but consumers are also facing higher insurance quotes and general maintenance costs. If interest rates continue to fall as expected, auto loan refinancing is also likely to see a resurgence in demand. An uptick in electric vehicles and hybrid vehicles will also affect the markets. These vehicles, in many cases, have uncertain resale values and may result in more consumers with negative equity if values fall. Many issuers are also looking into increased disclosure to investors around electric and hybrid vehicles and what percentage of their pool these make up, with an increased global focus on more energy efficient alternatives to gas-powered vehicles. The Consumer Financial Protection Bureau and state regulatory agencies are expected to continue to be active in review and oversight of auto loan originators and servicers. In particular, we've seen a focus on deceptive practices and add-on products. More generally, auto-related subscription services are becoming more common, despite consumer pushback. It's uncertain how regulatory agencies will view these types of programs. The Securities and Exchange Commission may also have another opportunity to weigh in on public auto ABS programs, with a number of big issuers having shelf registration statements coming up for renewal at the end of 2024 and early 2025. In addition to an active auto space, we expect to see a continued resurgence in the equipment space. Even smaller companies are seeing the advantages of term securitization transactions and looking at jumping into the markets for the attractive pricing, at least relative to private lending. It's still unclear if equipment spreads will follow the auto ABS trends and continue to tighten in 2024. Lastly, we expect some changes to the traditional auto and equipment ABS space, with a continued focus on capital relief trades and more banks looking into these transactions. Fintechs are also likely to expand into the auto market as a way to fuel expanded product offerings, which could result in yet more new market participants. That's it for auto and equipment today. Evan will now weigh in on developments in trade receivables.
Hi, I'm Evan DeCrease, and I'll be discussing developments in trade receivables finance. Growth in the sector has led industry participants to look to finance tougher to finance receivables. Some trends that we've seen and spoken on in recent years include financing receivables of weaker, distressed, and even bankrupt credits, financing receivables generated offshore, and providing off-balance sheet financing. This year, 4 trends that we wanted to highlight include financing receivables owing by governmental entities, financing healthcare-related receivables, providing leverage to secondary purchasers and aggregators of receivables, and monetizing inventory. On the first topic, some companies looking to finance their receivables have significant exposure to state, local, and the federal government as the underlying obligor. Consider, for example, a defense contractor. While on the one hand, governmental entities are highly rated and creditworthy in the conventional sense, on the other hand, the government is protected from certain rights and enforcement actions of assignees of receivables. The first key regulatory framework is the Federal Assignment of Claims Act. The Federal Assignment of Claims Act exists to protect the federal government from double payment risk. Typically, an assignee of a receivable acquires the assignor's enforcement rights against the underlying account debtor under Section 9404 of the UCC. However, assignees of government receivables can't enforce directly against the government unless they first comply with the requirements of the Federal Assignments of Claims Act. In a typical trade receivables deal, there's a number of practical hurdles to compliance. The Federal Assignment of Claims Act requires contract by contract compliance, so you can't just have a single blanket agreement between the assignor and the government. It also requires each relevant governmental agency to consent. So if you're dealing with the DOE and the DOD, et cetera, you need to obtain consent from each and on a contract by contract basis. States and municipalities often have an analogous assignment of claims rules for receivables owing by the state of Florida or Illinois, et cetera. So accordingly, if you don't comply with the Federal Assignment of Claims Act, which is most typical, any enforcement actions need to be taken by or through the assignor, and that of course can be complicated if that assignor is out of the picture. Another issue that you run into is that assignees can't cut off the government's offset rights by delivering notices under 9404. As a result, you have some additional offset risks relative to other receivables. And you also have some additional sources of offset obligations for things such as taxes, penalties, and fines that wouldn't necessarily rise in the typical commercial setting. But notwithstanding these issues, it's important to keep in mind that receivables owing by the U.S. government and various states are freely assignable, even if you do not need to comply with the Federal Assignment of Claims Act to assign the receivable, and that assignment is perfectly valid and enforceable against the assignor. The issues arise if you try to enforce directly against the government. This is not always the case in foreign jurisdictions, and special care should be taken before financing foreign governmental receivables. The second topic we had highlighted is the healthcare sector, which has seen a lot of activity. Healthcare receivables come with some hair, which includes concentrated pool of obligors, which include the Center for Medicaid Services, CMS, and a highly regulated industry. Healthcare receivables are typically paid by CMS, a private insurer, or the individual consumer. For receivables paid by CMS, the same issues that arise with governmental receivables exist, plus some additional issues. The most important of which is some additional cash management complexity. CMS regulations prohibit the government to pay to an account owned or under the control of anyone other than the counterparty or the assignor. As a result of these regulations, industry participants have developed workarounds such as a double lockbox approach, where the obligor will first pay to the assignor, and then the assignor is contractually required to sweep the funds to an account under the control of the assignee. However, this does introduce additional risk because that's just a contractual obligation, and there's no control over that first account. Where receivables aren't payable by CMS, they're typically payable by private insurers. There's not millions of insurers out there, so you have a relatively concentrated pool again, that you're funding against, and also where similar regulations affect various insurers. And then finally, where the patient's paying directly, that often comes with some additional regulatory considerations and scrutiny. Another issue in healthcare vis-a-vis other industries is that most states require physicians to own the practices, and clinical decisions need to be under the control of physicians. So where you have large groups of practices operating at scale that are looking to finance their receivables, they often have somewhat different ownership arrangements than a typical operating company. For example, rather than the ultimate owner may not own them directly through equity arrangements, but rather through management services agreements with physicians owning the practices. Then a third topic to discuss is that in recent years, funds and banks have strategically purchased receivables from disparate groups of originators and look to leverage these portfolios. These arrangements present some additional risks for lenders because they remove the lenders by a step from the origination and servicing functions and require some creative solutions to backstop indemnities and repurchase obligations. And then finally, since the pandemic, companies have held less inventory on their balance sheets and have looked for solutions to move inventory off balance sheet. In typical structures, inventory is sold by the supplier to an SPE. That the inventory is held by the SPE and then sold to the buyer as needed. If you're interested in learning more about these developments, please reach out for information about our trade finance seminar on April 17th in New York. And with that, I'm going to turn it over to Jim Antonopoulos.
Thanks, Evan. This is Jim Antonopoulos, and I'll spend a few minutes talking about two rulemaking updates that are important to the securitization space: the SEC's Conflict of Interest Rule and the recent reporting requirements under the Corporate Transparency Act. The SEC's Conflict of Interest Rule for securitization transactions was adopted on November 27, 2023. This rule is intended to implement portions of the Dodd-Frank Act that prohibit conflicts of interest, and securitization participants must comply with the rule with respect to any asset-backed security, the first closing of the sale of which occurs on or after June 9, 2025. Now, I won't be able to go into great detail about the rule or talk about the interpretive questions that have come up since the final rule was issued, given the short nature of this GFM recording. But I invite you to review detailed client alerts and dedicated GFM podcasts that a few of our colleagues have published in the last month. In general, this rule prohibits a securitization participant in an asset-backed security from directly or indirectly engaging in any conflicted transaction during the specified period. Under the rule, a securitization participant is an underwriter, placement agent, initial purchaser, or sponsor of an ABS, or any affiliate or subsidiary of any such person if the affiliate or subsidiary acts in coordination with any such person or has access to information or receives information about the relevant ABS or the asset pool prior to the first closing of the sale of the ABS. So this rule covers asset-backed securities, which include an asset-backed security as defined under the Exchange Act, and synthetic asset-backed security or hybrid cash and synthetic asset-backed securities. The adopting release makes clear that a corporate debt obligation is not a synthetic ABS for purposes of the rule, and a security-based swap is also not a synthetic ABS for purposes of the rule. The SEC specifies in the adopting release that a synthetic ABS is a security issued by a special purpose vehicle rather than a direct corporate issuance. Under the rule, the period of time securitization participants will be prohibited from entering into a conflicted transaction begins on the date on which that person has reached an agreement that it will become a securitization participant with respect to an ABS. And the rule provides guidance that an agreement refers to an agreement in principle and includes oral agreements and will be determined based on the facts and circumstances. And the prohibition period ends on the date that is 1 year after the date of the first closing of the sale of the ABS. So what transactions are actually prohibited under the rule? A securitization participant is prohibited from directly or indirectly engaging in any transaction that would involve or result in a material conflict of interest between the securitization participant and an investor in the ABS. A transaction results in a material conflict of interest if that transaction is a conflicted transaction. The rule goes on to define a conflicted transaction as any of the following transactions where there's a substantial likelihood that a reasonable investor would consider the transaction important to that investor's investment decision. First, a short sale of the ABS. Second, the purchase of a credit default swap or other credit derivative where the securitization participant would be entitled to receive payments upon the occurrence of specified credit events in respect of the ABS. Or the purchase or sale of any financial instrument or the entry into a transaction that is substantially the economic equivalent of these transactions. And for the avoidance of doubt, any transaction that only hedges general interest rate or currency exchange risk is not considered to be a conflicted transaction. The rule excludes risk mitigating hedging activities, liquidity commitments, and bona fide market making activities from the definition of a conflicted transaction. In the few minutes I have left, I'm going to talk about new reporting requirements under the Corporate Transparency Act that went into effect on January 1st of this year. The CTA requires all legal entities created in the United States and non-US entities registered to do business in the United States to report certain initial beneficial ownership information with the Financial Crimes Enforcement Network of the U.S. Department of Treasury, or FinCEN. As a bit of background, the CTA was enacted in 2021 and requires FinCEN to implement a beneficial ownership information reporting requirement as part of the establishment of a national beneficial ownership registry. The registry maintained by FinCEN will be available to U.S. law enforcement and national security officials to prosecute terrorism, money laundering, tax evasion, fraud, corruption, and other illegal activities. Under the CTA, a legal entity is required to file its beneficial ownership information with FinCEN if the legal entity was created by filing a document with the Secretary of State or a similar office under the laws of a U.S. state, or registered to do business in any U.S. state by the filing of a document with the Secretary of State or similar office, unless the entity qualifies for an exemption. Under the rule, there are 23 narrowly defined exemptions from the filing requirement for entities controlled by large operating companies and certain pooled investment vehicles. There's also a large operating company exemption and an exemption for certain subsidiaries of entities otherwise exempt from the reporting requirements. The CTA requires disclosure to the U.S. government of personally identifying information of the beneficial owners of the reporting company, as well as the personally identifying information of a company applicant. Under the rule, a beneficial owner is any individual who exercises substantial control over the reporting company or who owns or controls a 25% ownership interest in the reporting company. A company applicant is any individual who directly files the document that creates the domestic reporting company or registers the foreign reporting company, and the individual who is primarily responsible for directing or controlling such filing if more than one individual is involved in the filing. The information about the beneficial owners and company applicants that need to be filed include the legal name of such person, date of birth, current address, and an identification document with a unique identifying number like a passport. For entities formed prior to January 1, 2024, the entity will have 30 days to submit a report beginning January 1, 2025. For entities formed in 2024, the entity will have 90 days to submit a report. And for entities formed after January 1, 2025, the entity will have only 30 days to submit the report. If information on a previously filed beneficial ownership information report changes, the entity must file an update within 30 days of the change. And finally, filing a false report or failing to file a report can lead to civil or criminal penalties for a reporting company and certain individuals associated with the reporting company. I want to thank our audience for listening today. Listeners, if you have any questions about today's podcast or anything else related to global financial markets, please email us at gfm@mayorbrown.com. Thanks for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.